So imagine a local economy where job growth is just surging, right?
Mhm.
Population metrics are incredibly strong.
Oh, absolutely booming.
Yeah, but here's the catch. Almost no new commercial space is being built. I mean, basic economics tells you warehouse rents in that kind of environment should be, absolutely
Right.
skyrocketing.
You should be going through the roof.
Exactly. But if you look closely at the data today, those rents are actually falling.
Which completely defies conventional logic.
It really does. It's totally backward until you start picking apart the underlying mechanics.
It's a massive contradiction, honestly. And yet, if you look at the trailing 12 months, this local industrial market saw $8.3 million in sales volume.
Wow, 8.3 million.
Yeah, turning over 1.3 million square feet of inventory. So even with that bizarre fundamental disconnect, I mean, local capital is heavily active.
Which is exactly why we are pulling out the magnifying glass today. Welcome to this custom deep dive. We are bringing you a highly targeted, exclusive look at the Q1 2026 industrial commercial real estate market for Coeur d'Alene, Idaho.
And for those of you outside the region, remember that is pronounced Coeur d'Alene.
Yes, Coeur d'Alene, good catch. But just to keep things moving for the rest of this deep dive, we will refer to it simply as the CDA market.
It is definitely a market that demands a nuanced approach right now,
Yeah.
especially if you are, holding assets there or looking to deploy capital.
Right. And the insights we are unpacking for you today are drawn directly from the Q1 2026 CoStar Capital Markets and Industrial Market Reports.
Along with local economic data, of course.
Yeah, and extensive research compiled by Eric Peterson at ACTIV8 Real Estate. Oh, and by the way, if you are modeling out your own portfolio scenarios based on this discussion, you can reach Eric directly at 509-903-9077.
Highly recommend reaching out.
Definitely. Our mandate here is to basically cut through the noise, figure out why the CDA market is currently detaching from national averages, and pinpoint where the smart money is quietly positioning itself next.
So let's start by looking at that bizarre stalemate you mentioned at the top. We have a situation where the core metrics are in this tense standoff.
Yeah, let's break this down rather than just listing numbers because the conflict in this data is, well, it's fascinating.
It really is.
So on one side, you have vacancy holding perfectly stable at 6.4%, which, I mean, that matches the end of 2025.
Right. It's just a microscopic bump from 6.2% a year ago.
But the real shocker here is the supply side. There's practically nothing being built.
That is the understatement of the quarter, honestly. The construction pipeline is basically non-existent.
Like completely flat.
Pretty much. I mean, we're looking at a mere 52,000 square feet currently under construction.
Wow.
Yeah, when you weigh that against the total market inventory, it represents 0.5%, 0.5%.
That's nothing.
It's a radically tight supply constraint.
Right. So, okay, if I am a landlord sitting on existing space and nobody is building anything to compete with me, I am assuming I have immense pricing power.
Naturally. You'd think so.
Right. I should be able to push asking rents up aggressively. But the market asking rents are sitting at $10.41 per square foot.
Which is, surprisingly, a year-over-year contraction of negative 0.7%.
Exactly. So the leverage hasn't materialized for landlords at all?
Not even a little. And yet, trailing 12-month net absorption remains positive at roughly 35,000 square feet.
So tenants are still taking down more space than they are giving back?
Yes, the market isn't emptying out, it's just stubbornly refusing to pay more for the space it occupies.
To put it in a summary line, the CDA market is currently in a holding pattern of stability, characterized by tight supply and flat rent growth, just waiting for the next major economic catalyst.
That's a perfect way to phrase it.
It's a classic holding pattern, suspended between a tight supply that should drive prices up and an invisible ceiling that is actively pushing rents down.
And we really need to dig into that invisible ceiling, because if you look at the National Industrial Sector report for the same Q1 period, national rents actually grew by 1.2%.
Right, so it's like a localized microclimate. While the rest of the country is experiencing a slight inflationary warmth in rents, the CDA market has this cooling breeze.
Yeah, and to understand the mechanics of that cooling breeze, you have to look at the historical velocity of this specific market.
Okay, what do you mean?
Well, over the past 5 to 10 years, CDA experienced explosive, uninterrupted rent growth. We're talking about a 5-year average annual rent growth of 3.7%
That's huge.
and a 10-year average of 4.5%.
Oh, wow. So the local tenant base has already absorbed a decade of aggressive compounding rent hikes.
Precisely. So think of local tenant operating margins as a geographic mountain range ringing the city.
Okay, I like that visual.
For years, outside inflation and heavy demand pushed rents higher and higher. But eventually, those rents hit the mountain range. The absolute limit of what a local distributor, a specialized manufacturer, or a regional logistics hub can pay before their business model breaks.
Right. They simply can't pass any more costs onto their own customers, so they push back on the landlord.
And that localized resistance blocks the national inflationary trend from pushing rents any further. The market simply exhausted its ability to absorb premium pricing.
Which drastically alters how you have to underwrite a property today if you're a landlord. I mean, you can no longer buy a Class B warehouse, blindly write in a pro forma that assumes 4% annual rent escalations, and expect the local economy to swallow it.
Absolutely not. You have to underwrite for flat or even slightly negative near-term income growth.
But flip the perspective for a second. If you are a tenant operating in this space, especially if you have lease renewals coming up in 2026, this is the first time in a decade you have a semblance of leverage.
Yeah, you aren't staring down the barrel of an automatic major hike, and that breather is vital for local business health.
So the critical indicator here is whether that breather lasts. I mean, if you are analyzing this space, you want to watch the logistics and specialized industrial spaces.
Keep a very close eye on them. Do they continue to see this slight negative pull, or does that incredibly tight construction pipeline at 0.5% eventually force rents back up?
Right, forcing tenants to either pay up or leave the region. That tension is going to be the defining narrative. But there is one massive exception to that localized rent ceiling, isn't there?
Oh, yeah. There is a specific submarket where demand is about to completely detach from standard warehouse economics.
You are talking about the med-industrial catalyst in Post Falls?
Yes, the med-industrial phenomena. This completely changes the math.
For context for our listeners, North Idaho is currently the top-performing metro in the entire state for job growth, and a massive driver of that is the new 30-acre Prairie Medical Campus by Kootenai Health and Multicare in Post Falls.
It is a generational development for the area. I mean, they recently secured approval for a taller emergency department tower, and the first phase includes a new micro-hospital.
Now, at first glance, a hospital expansion feels entirely disconnected from the industrial sector. I mean, you think of doctors, waiting rooms, and MRI machines, not, loading docks and 24-foot clear heights.
That is such a common oversight. Modern healthcare is fundamentally a massive, high-speed logistical operation.
Okay, break that down for me.
Well, picture a new micro-hospital or a massive emergency tower. Real estate on a 30-acre medical campus is incredibly expensive. They do not use prime clinical square footage to store thousands of IV bags, sterilized surgical kits, or massive biotech testing equipment.
Oh, right. They outsource the storage to industrial parks 5 minutes down the road.
Always. You need healthcare-adjacent industrial space. You need highly specialized sterilization facilities, secure cold storage for biotech and blood supplies, and 24/7 delivery fleets.
The logistics of keeping a hospital running.
Exactly. The existence of this campus creates a massive long-term demand driver for very specific, sticky industrial tenancies.
But wait, let me push back on that for a second. If that structural demand is so inevitable, does this explain why Post Falls has the highest submarket vacancy right now at 10.5%?
It's a great question.
I mean, they are sitting on over 467,000 square feet of empty space. Are developers just front-running this medical demand?
Context is everything with that specific number. When you introduce a generational medical development into a submarket, standard timeline assumptions break down.
So it's intentional.
Highly likely. That 10.5% isn't necessarily a sign of a distressed market. It's shadow inventory.
Shadow inventory, meaning it's not abandoned, it's waiting room space. Savvy investors purposefully holding properties, waiting for the broader healthcare ecosystem to mature.
Exactly. They know the medical supply companies and the biotech logistics providers are coming.
So what should we be watching here?
Next quarter, watch Post Falls absorption rates. We need to see if those medical-adjacent tenants start eating into that 467,000 square feet of vacant space.
If you see absorption suddenly spike there while the rest of the CDA market remains flat, that med-industrial thesis is fully validating itself.
Absolutely. Which brings a whole new layer of strategy for anyone looking to acquire space.
But, buying or developing that specialized space requires capital, which pulls us out of the local microclimate and straight into the macro weather system.
Right into the macro tailwinds.
Yeah, we have to talk about the transition from quantitative tightening to what feels like a localized QE light.
This is the macroeconomic current running beneath all of the local data. If you look at the Federal Reserve data, they halted their aggressive balance sheet runoff in late 2025.
And now,
Now they're actively buying roughly $40 billion a month in targeted Treasury bills.
let's trace the mechanics of that. It's like the Fed unclogging a drain, right? For the last 2 years, the Fed pulling liquidity out acted like a stopper. Local banks had less capital, lending was strict.
Prohibitively strict in some cases.
But with this $40 billion a month, liquidity is steadily flowing back into the banking system.
And we can connect this directly to commercial real estate. This liquidity injection is expected to gradually ease lending conditions through 2026.
Specifically for shorter duration bridge and construction loans, right?
Yes, when banks have more reserves, the pressure to deploy that capital increases.
And if we map that macro liquidity directly onto the CDA industrial market, it collides perfectly with our first point. We have a market with only 0.5% of its inventory currently under construction.
Almost nobody could get a loan to build over the last year.
So with only 0.5% under construction, we have to watch if this new banking liquidity sparks a wave of new development loans in the coming quarters.
It is a delicate domino effect. But, we don't have to rely purely on forward-looking theory.
True, deals still got done despite the tight lending over the past year.
Exactly. Let's look at the trailing 12-month tape from the CoStar data. It reveals some highly revealing closed deals.
Okay, let's look at the tape. The market average sale price right now is hovering around $113 per square foot.
Keep that baseline in mind. There are two significant closed deals that shatter that baseline. First, Nathan Sukiya purchased roughly 17,000 square feet. That deal closed for approximately $3.3 million.
Okay, let me run the math on that. $3.3 million across 17,000 feet. That comes in at roughly $188 per square foot.
Quite a jump over the 113 average.
A massive jump. What is the second deal?
The second deal involves Scott McPhee, who took down a much smaller footprint, roughly 5,700 square feet. But that transaction closed for approximately $1.5 million.
$1.5 million for under 6,000 feet. That translates to an astounding $272 per square foot.
It's massive.
We have a striking discrepancy here. To go from a $113 market average to $272 means we're missing a piece of the puzzle. I mean, who were the sellers, what were the cap rates, and what are the specific deal types for those two transactions?
Well, I have to stop you there. Those specific metrics, the sellers, cap rates, and specific deal types, are not specified in the report.
Ah, hitting the data wall. We only work with what the report verifies. But even without those details, the raw per square foot math tells a story. Based purely on the math, these must be highly specialized assets or premium locations, right?
Absolutely.
Yeah.
It underscores that average market pricing doesn't dictate the ceiling for premium deals. Buyers will pay heavily for turnkey infrastructure they don't have to build themselves.
Especially when construction loans have been so hard to come by. Which begs the question, how do these high-priced deals fit into the broader investment landscape of the CDA market?
Well, looking at the total scale, the total asset value of the CDA industrial market currently sits at a very robust $1.2 billion.
Over $1 billion. That's significant institutional scale.
It is. And the market cap rate is currently sitting at 8.6%.
8.6%. If we cross-reference that against the national sector report, the national average cap rate is hovering around 7.3%. So the CDA market is notably higher.
Considerably higher, yes.
But cap rates don't exist in a vacuum, so I want the nitty-gritty financing details. What are the exact interest rates, spreads, and LTV conditions currently dictating these cap rates, and what is the exact breakdown of buyer types?
Again, specific current rates, spreads, LTV conditions, and exact percentage breakdowns of buyer types are not specified in the report.
Okay, the report is guarding the proprietary debt metrics.
But the data does indicate activity from individual buyers and portfolio operators. And we can infer a lot from that cap rate.
Right. An 8.6% cap rate implies investors are demanding higher yields to offset local risks.
Exactly. Or they're taking advantage of the pricing disconnect from national averages. They're demanding a higher yield to offset the perceived risk of a smaller geographic footprint compared to, say, Los Angeles.
It's the cost of doing business outside the top major U.S. metros. So we have covered incredible ground today. How do we synthesize all of these competing forces into an actionable outlook?
The data points to two forward-looking watch items for you through the end of 2026. The first is a steady vacancy creep.
A slow drift upward?
Correct. Overall market vacancy is forecast to tick up slightly to 6.6% by the end of 2026, alongside a continued mild rent contraction forecast at negative 0.3%.
So keep an eye on whether the medical campus demand and post-falls can offset this broader cooling.
Precisely. And the second shift to watch is cap rate compression.
Tying back to the Fed's liquidity injection.
Yes, with the Fed injecting $40 billion a month in liquidity, watch to see if that high 8.6% local cap rate starts compressing closer to the 7.3% national average as borrowing becomes easier.
The local risk premium slowly shrinking as capital gets more aggressive. That makes total sense.
It's going to be a fascinating dynamic to watch play out.
Which leaves me with one final provocative thought for you to ponder. We spent a lot of time analyzing why industrial rents are slightly negative right now, but let's look at the broader economic engine of northern Idaho.
It's a powerhouse right now.
It really is. It is outperforming the entire state in job growth. And beyond that, the region is generating an astonishing amount of capital, roughly $1.25 billion in direct tourism spending alone.
That's a massive influx of capital.
Right. So if northern Idaho is outperforming the entire state in job growth and generating over $1 billion in tourism spending, how long can industrial rents realistically stay negative before the sheer gravity of regional population and economic growth forces a dramatic upward correction in warehouse space valuation?
It's an economic pressure cooker. Something eventually has to give.
Exactly. Identifying exactly when that pressure releases will dictate the winners in this market over the next 24 months. And to time that release, you need an expert embedded in the data. For a custom market breakdown, contact Eric Peterson at 509-903-9077.